$1,000 per year for those under 50, while Roth IRA limits max out at $6,500. Even if you're disciplined, a Roth IRA alone cannot match the sheer volume of potential contributions from a 401k with employer match. For Americans serious about building wealth efficiently, ignoring the match is a costly mistake. Contrast also exists in growth timelines. Employer matches are invested and compounded alongside your contributions. That $1,800 Sarah receives in year one doesn't just sit there, it grows. After 20 years, that employer money alone could be worth tens of thousands, thanks to the magic of compound interest. Mike's Roth IRA contributions grow tax-free. Yes, but the initial boost Sarah receives from her employer accelerates her progress in ways that are difficult to replicate elsewhere. Timing and consistency matter, too. The earlier you contribute, the more impact the match has. Young professionals, even those making minimum contributions, benefit disproportionately from the match over decades. Older employees can still catch up, but maximizing the match early is one of the easiest ways to create exponential growth in a retirement account. Finally, consider behavioral benefits. Knowing the match is there often encourages employees to contribute more of their own money. The psychological effect of free money motivates consistent saving. Sarah initially hesitated to contribute 6%, but seeing the company match nudged her to commit fully. Mike, managing a solo Roth IRA, doesn't get that nudge. He has to rely entirely on personal discipline. In conclusion, employer matches aren't just perks, they're strategic tools. They provide instant returns, amplify compounding, and reward early action. Once you've mastered the basics of contribution limits and employer matches, the next key piece of the retirement puzzle is investment flexibility. How your money grows is just as important as how much you contribute. Let's continue with Sarah and Mike. Sarah's 401k offers a range of funds, index funds, target date funds, and a few actively managed options. Mike's Roth IRA, meanwhile, gives him virtually unlimited access to stocks, bonds, ETFs, and mutual funds. At first glance, Mike seems to have the advantage. But flexibility isn't just about access. It's about making smart choices aligned with your goals. In Sarah's plan, many of the actively managed funds come with higher fees, which can quietly erode growth over decades. Contrast that with low-cost index funds, which track the market at minimal expense. For most Americans, especially beginners, these funds outperform expensive options in the long run. Mike, using his Roth IRA, can select similar low-cost index funds, or even diversify internationally, giving him a wide range of options to match his personal strategy. Target date funds in a 401k provide simplicity and peace of mind. Sarah doesn't have to decide exactly which mix of stocks and bonds to hold. Her fund automatically adjusts allocations as she nears retirement. For many, this convenience is invaluable, but it comes at the cost of less control. Mike, on the other hand, must actively manage his Roth IRA investments, which can feel overwhelming for beginners. Yet this control allows him to tailor risk, explore niche investments, or increase exposure to sectors he believes will outperform. Another contrast is tax treatment on investment growth. Roth IRAs grow tax-free, allowing Mike to take advantage of compounding without worrying about taxation later. Sarah's 401k grows tax-deferred, meaning she won't pay taxes until withdrawal. While both grow, the Roth gives more predictability, especially if tax rates rise in the future. This makes investment choice in a Roth IRA even more powerful. She can choose higher growth options without fear of the tax bite at retirement. Liquidity is another factor. Mike can access his contributions, not earnings, from the Roth IRA at any time without penalties, making it a bit more forgiving if life throws unexpected challenges. Sarah, bound by 401k rules, faces penalties if she withdraws early. This difference may influence the types of investments each chooses. Mike can afford slightly higher risk options, knowing he can adjust if necessary. The range of asset classes also matters. US stock funds are popular and safe, but diversification across international stocks, bonds, REITs, and even commodities can help reduce risk and smooth returns over time. Mike has access to all of these in his Roth IRA, while Sarah is limited by her 401k menu. For long-term growth, understanding your options and how they match your risk tolerance is critical. Behavioral flexibility is also key. Sarah's limited menu may prevent impulsive, higher-risk moves, which is good for emotional investing. Mike's broader options require discipline. Without it, he could chase trends, hurting long-term outcomes. Here, education and guidance become essential. For Americans, balancing flexibility with discipline ensures that retirement investments grow steadily and safely. Finally, contribution strategy interacts with investment choices. Both Sarah and Mike can automate their contributions, but how those funds are allocated across different assets will determine growth. Mike can split monthly contributions across multiple ETFs and mutual funds within the Roth IRA, tailoring exposure to match goals. Sarah's 401k may auto-invest in a single target date fund, giving simplicity but less personalization. In conclusion, investment flexibility isn't about having unlimited choices, it's about making informed decisions that maximize growth while managing risk. The balance between control, simplicity, cost, and tax efficiency defines success. For Americans aiming for long-term wealth, understanding how to leverage both 401k and Roth IRA options empowers smarter decisions. Sarah and Mike show that the combination of automation, disciplined investing, and strategic flexibility is the foundation for a secure, prosperous retirement. Saving and investing are only half the story. The final piece of the retirement puzzle is knowing how to access your money wisely. Sarah and Mike have both built substantial nest eggs through their 401k and Roth IRA. But now the question is, how do they convert those savings into a reliable, lasting income without unnecessary taxes or penalties? Let's start with Sarah. Her 401k is tax-deferred, meaning withdrawals are taxed as ordinary income. She needs to plan strategically to avoid high tax brackets in retirement. One effective method is staggered withdrawals, pulling just enough each year to cover living expenses while leaving the remainder invested to grow. Contrast this with lump sum withdrawals, tempting but risky approach that could trigger a large tax bill and deplete her savings faster than intended. By planning withdrawals carefully, Sarah maximizes her account's longevity while maintaining tax efficiency. Mike, on the other hand, has a Roth IRA. His contributions are post-tax, meaning withdrawals are completely tax-free. This flexibility allows Mike to control his taxable income each year. For instance, if he also has a 401k, he can strategically withdraw from the Roth IRA in higher income years to avoid pushing himself into a higher tax bracket. The contrast here is clear. Sarah must factor taxes into her withdrawal strategy, while Mike enjoys more predictable, tax-free income. For most Americans, combining accounts like this offers a powerful way to manage both growth and taxes. Another important consideration is required minimum distributions (RMDs). Sarah's 401k will force her to start taking distributions at age 73, whether she needs the money or not. These RMDs are taxed as income and can impact Social Security benefits, Medicare premiums, and tax planning. Mike's Roth IRA has no RMDs, giving him the freedom to leave the funds invested for as long as he wants. For long-term planning, this difference can be a major advantage, allowing Mike to pass on more wealth to heirs or continue compounding growth well into retirement. Timing and sequencing matter, too. Many Americans make the mistake of withdrawing from taxable accounts first, depleting short-term liquidity while leaving tax-advantaged accounts untouched. A more strategic approach is the tax-efficient withdrawal ladder. Tap taxable accounts first, then 401k or traditional IRAs, and leave Roth funds to grow until later years or use for emergencies. This approach balances liquidity, tax efficiency, and long-term growth. Another key factor is inflation protection. Over decades, even modest inflation can erode purchasing power. Both Sarah and Mike need to maintain a portion of their portfolio in growth-oriented investments, even during retirement. This might include low-cost, equity index funds or bond ladders that adapt to interest rate changes. Without this consideration, retirees risk outliving their savings. Behavioral strategy plays a role as well. The temptation to overspend, especially after years of disciplined saving, can derail long-term security. Both Sarah and Mike benefit from a planned withdrawal rate commonly cited as 3 to 4% annually of the portfolio, which allows sustainable income while leaving room for market growth. This disciplined approach ensures that their accounts last throughout retirement rather than being exhausted prematurely. Finally, planning isn't just financial, it's holistic. Healthcare costs, lifestyle goals, and even charitable giving should factor into withdrawal strategies. For example, Mike can use Roth IRA withdrawals to fund travel or education for grandchildren, tax-free, while Sarah may need to coordinate 401k distributions to cover insurance premiums. Thinking ahead and aligning withdrawals with personal goals ensures retirement is both secure and fulfilling. In conclusion, building wealth is only the beginning. The real power comes from strategic withdrawals, tax planning, and long-term foresight. Americans who understand these principles, like Sarah and Mike, can enjoy retirement with confidence, freedom, and financial resilience. By combining thoughtful investment strategies with disciplined, tax-efficient withdrawals, you can maximize the value of every dollar saved, secure your lifestyle, and leave a lasting legacy.